In this video, I'm going to talk about how to boost your refunds for 2020. So first, I'm going to tell you how taxes work. Then I'm going to show you how to adjust your W-4 so you can boost your refund. And then last, but certainly not least, I'm going to show you how to use your credits and your deductions to your advantage so you can boost your refund. But before we do, if this is your first time at our channel or you haven't subscribed, click on the subscribe button at the bottom. My name is Travis Sickle, certified financial planner, helping you reach your financial goals. Okay, so let's jump into it. I'm gonna go into an example that you can use for both 2019 and for 2020. It doesn't matter, and it also doesn't matter your filing status or your income levels because the example is going to apply to everybody. So in your particular situation, even though I'm gonna go over married filing jointly, if you're single or head of household, take the concepts, apply them to yourself, and I'm gonna show you exactly how to do it. So let's go ahead and jump right into the example behind me so I can show you how taxes work. On this side are the tax brackets for married filing jointly, and over here I have it broken down. So you can see all the different tax brackets. Now this is for 2020, not 2019. These are the different tax brackets, but again, it's gonna apply to you. It doesn't matter what tax year you're in. So 10% goes from 0 to 19,750, 12%, so on and so forth, up to 8,250, 22%, 24%, all the way down to 37%. You can see all the tax brackets on this side. And now here I have it broken down. So this is how it's done. So you have $100,000 and then we start with the standard deduction of $24,800. Now, the first $24,800 for 2020 is the standard deduction, means it's not taxable. It's not taxable dollars. So then we're gonna go over to the tax brackets behind me and look at that first 10% tax bracket. That's at $19,750. So what that means is every dollar after that up for the next $19,750 is gonna be taxed at 10%. So that brings us from $24,800 plus the $19,750 to $44,550. That's at 10%, which is $1,975. So that's how much tax we're gonna pay on those dollars. Then above and beyond that, the rest of the dollars, all the way up to $100,000, is another $55,450. And if this is confusing, just stick with me because it's gonna make sense in a couple of minutes. So then the next $55,450 is gonna be at 12%, which works out to $55,450 times 0.12, which is 12%. 0.12 is gonna be $6,654. Now, if we add this number up and this number up, we're gonna get a total tax liability of $8,629. Now, I went through that pretty quickly just so you can see how it stacks up on the example. Now, if we made more money than that, then we would look back over at the tax brackets and continue moving up the ladder. But the first thing that I want to point out is at $100,000, if we look over to the tax brackets, we see where $100,000 falls, and that's at 22%. But we're not paying 22% on any dollar because the standard deduction. The standard deduction is lowering our total taxable income. In fact, it's lowering it to the addition of this number and this number, which is going to be $75,200. So that's where we're getting our taxable income from. So in this example, $100,000, our total tax liability, given this example, married filing jointly, $100,000 and nothing else. So we're not saving any money at this point. We're doing nothing else. No other deductions. It's going to be $8,629. Now that's how taxes work. I want to jump into the W-4 with the same example and compare the two so you can have more control and really understand how to make this adjustment. So this is the W-4, the online estimator. Now, if you don't have the online estimator, I'm going to put a link in the description at the bottom so you can walk through it. I've done a ton of other videos on the walkthrough. This, I'm just going to explain how to make the adjustment. But if you want the full walkthrough, go watch some of my other W-4 videos so you can see exactly how to do this. So this is going to be for married filing jointly. And as you can see here, we're only going to have one job. So the income is one job. Even though we're married filing jointly, just to keep this example super simple, I only marked off one job for the household and I went on and clicked on next. Now for this job, you can see right there, I put in $100,000 and I put in an estimate of what we've already withheld. Now that's coming from your last pay stub. So you want to put that information in there. And you can see that I didn't put anything for the 401k or the cafeteria plans, HSAs. And then over here with the adjustments to income, I just said, let's go to the next step. Same thing for the standard deduction. I took the $24,800. You could see it right there. Go to the next step. And we're not going to take any credits just yet. I'm going to show you how to adjust that in a minute. So you can see it's basically the same number. We're going to look at that as a rounding error. So our anticipated tax obligation is $8,632. And from what we've put in already, we're going to withhold $8,640, meaning we're going to get an $8 refund, basically zero. So if we want to make an adjustment, so this is the first adjustment you can do to boost your refund. Now this is on the W-4. So we're going to scroll down just a little bit and you're going to see this slide bar here. Now, before we adjust that, I want to show you what this is going to look like. So if we scroll over to, let's say we wanted a $2,000 refund, it's going to tell you exactly what you need to put on your W-4 in order to get a $2,000 refund based on what you already put in. So it's giving you your current situation and you're saying, okay, my current situation, it's showing that I'm not going to get a refund or have to owe, but if you want to boost and get a refund, then you can just slide that bar over and you can slide it up to $2,000 and it's going to help make that adjustment. Now, in this example, what it's telling us to do is put $100 in additional withholdings per day or per pay period. So that's going to be the $100. Now that's going to go right in the adjustment section and you're going to see that in a minute when I click on it. On the download pre-filled form W-4, that link right at the bottom, it will pre-populate the number right in that section that you can give to your employer. And that's all you need to do if you're making the adjustment to boost your refund. Now, that being said, if we take a step back, all we're doing is withholding additional dollars to get a bigger refund at the end of the year. Now, if you filled it out in the past and you're comfortable with doing that, then you can slide this bar to wherever you want to make sure that you're getting the same exact refund that you got in the past or whatever situation that you're looking to accomplish. Now, a lot of people do this because they're afraid that they're going to end up owing the IRS and they're afraid that they're not going to have enough money in the bank when that time comes. But the truth is, if you plan ahead and you go through the W-4 and you go through each of those different sections, you're going to have a really good idea of not only how your taxes are going to end up, but how to control them. So then you won't have that fear at the end of the year that you're going to owe. So it's really important that you go through this and understand how your tax situation works and what you can do to adjust it. So this is one thing that you can do to adjust it. Now, if you didn't want to do all the math that's behind me, then you can scroll down to the bottom here and it's going to give you all the information that we've already had. So let's look at this. Let's see the tax before credits. Now that is $75,200. Now let's come back to the screen for a second. If we add these two numbers up, $55,450 and then $19,750, well, that's going to be our $75,200. So it's right there in front of us. But if you don't want to go through that, you can go right to this section and see $75,200. And then we could take it $75,200. We know that we're in the 12% tax bracket. Now, the reason it's important to know that number and not just how much you're bringing in for $100,000, and this is really the more important number so far, because what we can start to do is we can look at some of our credits that we might qualify for and kind of plan ahead or save more money to get those credits or get those deductions. So it's going to be a little bit of a balancing act. So the first thing I'm going to point out is I'm going to show you three different scenarios on a high income, a medium income, and a low income. So we're going to start with the lower income option, and that's going to be the retirement savers credit. Now, I'm going to pull it up on the screen so you can see it along with me. So this is the 2020 Savers Credit. And if you look at that first column, married filing jointly, the highest income for married filing jointly that you can earn is $65,000, but that would disqualify us from this credit. But if we can just get a little bit below that, we can start to qualify for a partial credit for the saver's credit. So if we took our $75,200 and we maxed out our traditional IRAs, that is going to be pre-tax. So let's say that I did it and my spouse did it. That's going to be $12,000. So $12,000 off this $75,200 will put us below that $65,000 threshold. Now, for this particular calculation, that would put us at 10% of our contribution, but it's not the full contribution. So it's only up to $2,000 for you and your spouse. So the math on this is going to work out to be $2,000 for me and $2,000 for my spouse at 10%. That's an additional $400. So let's see how that works out. Let's say we put in an additional $12,000 into our retirement accounts. So first, we're going to take $12,000 right off of the $75,200. So that's going to give us our $800. And that is going to be 63. So we're right below the threshold, 63,200. But what we can also do is take this 12,000 off of this number. So right here, we can take 12,000 off of there. So it's 12,000 multiplied by 12%. So 12,000 times 12% is going to be 1.12 times, where are we? 12%, $12,000. That's going to be $1,440. So we can take this $6,654 now and subtract $1,440. So we're going to have $6,654 minus our $1,440 is going to be $52.14. So it's going to be now $52.14. So our total tax liability, we can just do it down here too. Instead of $86.29, now it's going to be $86.29 minus $1,440 is $7,189. So I'm going to put that over here, $7,189. But remember, that's not all. That's not all. We're also going to look at that saver's credit of $400. So an additional $400. So that's the nice thing about the credit. It's dollar for dollar on a credit. So we can subtract another $400 off of that, and that's going to be $6,789. 6,789. Quite a bit difference. Now we can do that on the W-4 as well, and I'll bring it back up on the screen. So if we go to our adjustments and see adjustments, and we can scroll down to the IRAs, and we're going to put in $12,000, $6,000 for me, $6,000 for my spouse. Click next. And then go back to the results. And that's $7,192. And what did we get? So it's pretty close to what we got originally at $7,189. So it's still the same $3 off. Wait a second. We have to go back to the tax credits. So let's go see our tax credits and look at the retirement savers credit. Enter the amount of any retirement savings contribution credit for which you expect to be eligible. So in this section, we want to put in $400. And look at that, 6,792. There you go, 6,789. Again, a rounding error right there. So that's how you can save additional dollars at the lower income level with retirement savers credit. So we went from $100,000 to start with down to below $65,000 just by making some adjustments. So at first glance, we make $100,000, but we have a standard deduction, which takes a huge chunk off our tax bill. And then if we save some money, then we're going to also get a credit. So that is a whole bunch of things that go into this that if you understand how it works, you're going to be better off. So that is just one credit. So let's look at a middle income level. Now let's take a look at an example of a little higher tax credit. So we can look at a premium tax credit. Now the premium tax credit is for healthcare, and it could be at a lot of different income levels, but I'm going to pull up a scenario for you that's going to show you a little bit higher income than what we just went through on the retirement savers credit. So let's pull it up right here. This is going to be the estimator for the premium tax credit. And if we jump down and say we're a family of 5 and we go down to Florida and we look at the income ranges, so above 126.80. So let's say, so that's this is exactly what you can go through for your particular household size. Now, it matters on how many people you put in and what state you're in. But for this, you can see it's $120,680. Now, the same concepts apply because if you're above that, you're getting the standard deduction, and then you can save additional dollars, whether it's in a traditional IRA or your 401k. But if you know where these numbers are, then you would qualify for additional credits, whether in this case, it's the premium tax credit, but whether or not it's one credit versus another, you need to know where they are so you can figure out how to get your income where you need it to be. So while you can still bring in the income, strategically saving it into these accounts will make the difference of whether or not you're going to get these tax credits. So that's additional dollars. And that is a big reason why you should look at these credits to make that decision between the Roth IRA and your 401k at work. So there's a lot of emphasis on saving into the Roth IRA, and it's a great savings vehicle, but it's not going to reduce your total taxable income to qualify for some of these credits that we're going through. So here you can see that it's $120,680. Again, that's going to change. If we only put a household of two, married filing jointly with no dependents, then that income level is going to drop significantly. So here you can see that it's $67,640 for the higher income side of the premium tax credit. So it's not only reducing your income when you're putting your money into your traditional IRA or your 401k, it's helping you qualify for these tax credits. Now, the top one is the child tax credit. So for singles for 2019 and for 2020, it's $200,000 for a single and it's $400,000 for married filing jointly. So this is another example of getting your income below that threshold using the same techniques to make sure that you're qualifying for that credit. Now that is a $2,000 credit to your taxes. So that can reduce it quite a bit. So let me jump into the same exact example with the $100,000 income earner and show you what that looks like when you're going after the child tax credit and adjusting your income. So I'm going to go back to the adjustments here for a second and get rid of the traditional IRA that we had saved before. And we're going to get rid of that savers credit as well. And we're going to go back to the results just to check that it's back to what we had before. So that's $8,632. So that's what we had before. So now we're going to go over and we're going to go back to the very beginning, and you're going to see a couple of changes on here. So the dependents, we're going to say yes, and we're going to say we have one dependent. And we're going to scroll back up to here. And it's really important that you go to the tax credit section if you're choosing a credit, because if you see right there, I changed that to a qualifying child because they're under the age of 17. We're going to say that we have one qualifying child. If you didn't do that, if you didn't do this, then it would qualify it as a dependent, which is only $500 versus the child tax credit, which is $2,000. So now we can come here and you can see the anticipated tax obligation dropped by exactly $2,000. So now it's $6,632 before it was $8,632. And if we scroll down and we put it to 0 for a second, and you scroll down, you're going to see that it's going to help us make an adjustment. Now, this is based on what we pulled off of our last pay stub. But look at this. If we choose that we want a $2,000 refund, it's going to make that adjustment and bring it down. Why is that? Because by adding first of all, it's making an adjustment. So that's why it didn't give us exactly $2,000. But then it's going in and saying, okay, well, you want the $2,000 back at the end of the year. So let's make an adjustment to your W-4 and really your paycheck. And that means you're going to get a smaller paycheck if you're getting a bigger refund at the end of the year. So it's really not advantageous to want to get a bigger refund at the end of the year. Now, if you're doing some of this stuff where you're putting money into your traditional IRA to reduce your tax liability, you can do that up until the April filing deadline, April 15th filing deadline. You can put the money into your traditional IRA and boost your refund. But you really don't want to do this if you don't have to. You want to save, but you don't want to get a big refund because it's your money at the end of the day. So whether or not you're getting it back today or at the end of the year, it doesn't matter. It's still your money. So we could go through this calculation and say, okay, I make $100,000. This is going to be my tax obligation, but I want a $2,000 refund. All that means is instead of withholding $8,629, we're going to withhold $10,629 and then just get it back at the end of the year. Doesn't make any sense. But a better way to do this is to take that money if you're worried about owing at the end of the year and just put it in the bank. Just keep it for yourself. Put it off to the side. So that's a great way to do it. So then you have the money there and it's getting a little bit of an interest. It might not be much, but it's more than nothing. So not only do you have the refund back technically early, you're getting a bigger paycheck, but now you have the money in the bank account, you're building an emergency fund. What's another thing that you can do with these dollars and boost your overall financial situation is get it back in early, not in a refund, get it back early, pay the right amount in taxes, and pay off some debt or save it. So I've talked a lot about saving, but you can pay off the debt. So not only are you controlling your paycheck, your taxable situation, but now you're controlling everything in your financial life. So you're knocking out your debt early. So imagine that if you had $2,000 back throughout the course of the year, and if you're at 10, 15, or 20% interest rate, that is exactly how much you're going to save on that $2,000. So that's a huge amount of money. So it's really important to go through this example yourself, figure out what filing status you are, look at the tax brackets and see where you fall, and see what other opportunities that you have available to you. There are just so many different scenarios. It's difficult to say that everybody can qualify for this credit or this deduction. You have to look at all the credits and deductions. A great place to start is the online estimator and just go down the list and see where those income limits are and see if you qualify or what you can do to qualify in order to get those credits. Now, if at the end of the year you do end up getting a big refund, but you didn't anticipate it, there's nothing wrong with that. Just look at your taxable situation and figure out, could you learn from it? Is there anything you can do moving forward from it to be proactive? Because if you can get a bigger paycheck now and save it, you're just going to be better off, especially if you can tackle some debt or just save additional dollars. You're just going to have way more options if you do it earlier rather than later. But if you are waiting until the last second, just know you can still contribute to some of your retirement plans like the traditional IRA or the Roth IRAs up until your tax filing deadline, or start early and start planning for next year. And that's where the W-4 comes in. So you can kind of tie these all together. If you have questions, leave them in the comments below. And if you've enjoyed this video, be sure to subscribe and leave your comments at the bottom.